I've been a financial advisor now for over 20 years. And during that time, I've worked with hundreds of millionaires, people in the top 10% and people in the top 1% of net worth in the United States. And in today's video, I'm going to share with you how the top 1% invest their money, because I think there's a lot we can learn from the top 1%. All right, let's go for a walk and let's talk about it. You know, the first thing is that wealthy families really don't look at money as a tool to buy things. Yes, they have a comfortable life. Yes, they have nice things in their life. But really, they look at money as a tool really for one of two things. One is to help skill up, to help give experiences and education, primarily to their kids, but to other people that they love and they care about. So that's the first thing, is to prepare the next generation to have comfortable and successful lives, whatever that means to them. But the second one that's more important to you and I is they look at their money as a tool for making more money. You know, many of us think of money as a tool that enables us to buy things, enables us to have experiences. And that's true. But it's also a tool that, if used properly, can be the gift that keeps giving over time. And that's one of the key things for the top 1%, is looking at money not as something to buy stuff with, but as a tool to buy assets that are going to produce income that over time is going to give them a higher return. And really, we have three different ways to do this. The first one is investing in publicly held companies through the stock market, the way most of us invest through our 401ks or IRAs, but maybe at a bigger scale, right? They've got more investments in that. So the first one is investing in what I call public stocks, public bonds, things that they know are going to produce money for them over time. The second way, and we're going to talk about the pros and cons of each of these, but I want to lay out all three of them. The second way that the 1% invest is looking at real estate. You know, real estate can be very tax advantaged. Real estate can give leverage. Leverage cuts both ways. Leverage is just a fancy way of saying debt. So they can get debt. If they buy a property for $5 million, they don't need to put down $5 million. They may need to put down $1.5 million, and the rest they can finance with debt. And actually, some of the really savvy 1% get other people to put in some of that equity, and then they benefit not just from the dollars that they put in, but also from the dollars that other people put in. But that's outside of the scope of this video. I'm going to really just talk about primarily traditional real estate, commercial real estate, residential, rental real estate, things like that. And then the third one that folks tend to invest in of those three is investing in businesses. You know, maybe they have a friend that started a company, and that CEO wants that company to grow more quickly. And so they take on an investment in that. And then the 1%, the family that invested it, the folks in the 1%, then they get to participate in the upside of that company, either, you know, somebody else's company or oftentimes their own company, because it's a risk that they know well, it's an investment that they know well. So let's talk about the pros and cons of each. Let's first talk about real estate. I'm going to leave public investments to last. So on the real estate front, you know, while real estate can have a good return to it, right, it also tends to be an active investment. It takes time to manage those investments, particularly the way you and I would invest in real estate, which would probably be primarily through rental properties. And, you know, properties have a way of, needing maintenance and work on them, and then maybe tenants leave and you need to replace the tenants and you have some issues there. So the real estate side can be fairly active, as can, you know, the third one was the businesses. And being an investor in a business, if you're a passive investor, it doesn't have to be time consuming. But oftentimes what happens is the folks that tend to do well investing in businesses are the ones that have good business skills themselves, and they can help the company owner achieve their goals. And so it tends to end up being an active investment for most of the people that I know that succeed at investing in businesses. So that's the second way. It also helps to have an expertise in that industry, right? Otherwise, you're taking a lot of risks that you don't even know that you're taking if you don't know the industry, just frankly because you don't know what you don't know. And some of this, there is an industry, venture capital, that invests in startups, and private equity that invests in later stage companies. But many of us have the opportunity occasionally, through our network, through our friends, to invest alongside a business. And that can, if you're good at business, if you have a good Rolodex and you can help that CEO get things done that he or she would not be able to do on their own, that can be a powerful tool. But I think the one that's most useful for most of us is investing in public equities. It's the most passive of the three that I just mentioned, right? I call it, you can vote with your feet. If none of us hit 1,000, and if you make a mistake, if you do an investment and you think, it's not the opportunity that I thought it was, well, if it's a public investment, companies that you and I have heard of, I try not to mention names on my channel, but if it's trading on a public exchange like the New York Stock Exchange or the NASDAQ, you can sell that. You can sell that relatively easy. You have liquidity. Unlike with a private company or real estate, where with a private company, it can take a year or longer to sell. Same thing with real estate. It depends on the cycle you're in. And both of those can be expensive to sell. The nice thing about investing in public equities and public bonds is, excuse me, not only can you sell those positions if you need to, but it's also very efficient. There's not high costs involved in buying or selling. That, of course, has changed really over my investment career. It used to be like $100 minimum trade commission, then it went down to $60, then it went down to $50, then like $25, $10, and now for many stocks, there's no commission. It doesn't mean that the custodians, companies like Fidelity and Schwab, it doesn't mean that they don't make money. It just means they make money a different way. We don't have to pay on that commission. So the advantages on the public side is that it tends to be very passive. Particularly as you get closer to retirement, you can invest in dividend-paying stocks. One of the things I like about dividend-paying stocks is if you choose wisely, and that's really the key, and I should say, none of this is financial advice. I don't know your situation, just some things that I want to have on your radar screen and for you to be thinking about. But if you choose your companies wisely with your dividend stock portfolio, and a dividend is just cash flows that the companies pay to their investors. So there are some companies that are all about growth. They're not going to give cash flows back to their investors. But there are companies that have sufficient cash flows. Not only can they reinvest in their company for their growth, but they can also share some of the cash flows that the company is generating. They can share some of that with investors. And if you're really looking for a passive investment, on the public side, it can be a wonderful way to do that without having to worry about, finding new tenants or replacing a water heater in the middle of the night, or helping a CEO hire a new vice president of sales or enter a new market. When you're in the public equities, you buy the stock and you wait for the dividends to come in. And if you're overseas on vacation, it lands in your bank and you take the money out wherever you are. So I think there's a lot of advantages. Now, clearly I'm biased, right? This is the industry that I work in. Full disclosure, I have done some small investing in some businesses, and I can tell you the more I do, the more I like the advantages and the simplicity and the liquidity and the efficiency and the passivity, being so passive with public stocks. So those are my thoughts on those three ways. Again, top 1%, tend to be investing in either real estate, businesses, or public equities. And if you enjoyed this video, I think you're also going to enjoy this video here, which talks about 3 signs that you're likely way above average. Thanks for watching this video, and I'll see you in there. Bye-bye.